I'm going to use my favorite snobby pleasure in the world, this Pellegrino, to show you why dollar cost averaging on the stock market is a stupid idea. If you haven't heard, dollar cost averaging is when you throw the same amount of money at the same index fund every month, month in and month out, to average out the highs and the lows over time. It was invented for people who want to invest without using their brains. And there's a better way. You want to buy stocks the same way I buy Pellegrino. Costco sells it in cases like this for 17 bucks, but every once in a while it goes on sale for 12 bucks. When it's 17, I'll buy one case. When it drops to 12, since I can afford it, I'll stack up and get 4 or 5 cases at a time, which usually lasts me until the next time it goes on sale, so I always get it for 12. This is what the smart investors do on the stock market. They trickle in a couple bucks while it's expensive, but they keep a big cash reserve, and when stuff goes on sale, they throw a whole stack at it.
Hey Dad, when's the best time to buy stocks? There isn't really a best time to buy stocks, and it's not great to try and time the market. But you can dollar cost average. What's that? It's when you invest the same amount of money every month or in regular intervals, so when the stock price is high, you'll get less shares, and when it's low, you'll get more. This way, the cost will be much cheaper compared to trying to time the market. Thanks, I'm gonna follow you for more.
You invest $100 at the beginning of the month. Your fund advances by 5%. You now have a total value invested of $105. At the end of the month, you invest another $100. You now have a total value invested of $205. During this second month, the stock market drops by 10%. You now have a total value invested of $185. You're at a loss. At the end of the second month, you buy again another $100 worth of stocks at these depressed levels, minus 10% measured from the peak. This third month, your fund advances by 7%. Now your total value invested is $305. You keep doing this for 10 years straight, never missing a payment, except instead of $100, you invest $500 a month. After 10 years, you have over $90,000. Your money grew by 8% every single year. That's the average return of the S&P 500.
You're right, that's why I invest in my favorite ETFs regardless of the price every single week, because nobody can time the market perfectly every single time.
Dollar cost averaging will always be the safest bet when it comes to investing. And if you don't know what dollar cost averaging is, it's basically periodically buying the same asset over time. So instead of putting in $1,000 into Bitcoin today, you put in $100 every week for 10 weeks. What this does is it averages out the cost of what you're buying. Doesn't matter if the asset drops in value or if it skyrockets, you're always going to get the average. This significantly reduces volatility and allows you to gain more money over time. So if you're just getting into crypto or stocks or any sort of investment, including dollar cost averaging in your investment strategy, probably won't